welcome to this FTI Treasury Talks, where we're going to be discussing some of the practical implications associated with adopting hedge accounting for Treasury transactions. My name is Justin Callaghan, and I'm the Chief Executive here at FTI Treasury, and I'm delighted to be joined by Marie Gaynor, who manages our accounting team. Here at FTI Treasury, we provide a range of services to corporate clients in the areas of Treasury, including everything from daily cash management to accounting services. And obviously today it's the accounting services which are particularly relevant. We're in a kind of a unique position where we get to see what a lot of multinationals do in terms of adopting hedge accounting for a whole range of different Treasury transactions. And what we'd like to give you today is just a little bit of insight as to what we see as some of the common practical elements that need to be dealt with in order to do that efficiently. Marie, you're the expert on this, so I'll stop talking and hand over to you. You might as well just start with the basics.
Sure.
What exactly is hedge accounting, and what can a corporate hope to achieve from adopting that?
Well, all derivatives need to be remeasured at accounting period ends at their fair value. So typically we use our treasury management system and our rates feeds from the markets to calculate the values at the financial period end. They then have to be posted through your accounts. So if the derivative has increased in value, then there will be income through the P&L, and if it's reduced in value, there'll be expenses through the P&L. So this then causes a lot of variability in your income statement. And really, the purpose of a hedging strategy is to sort of reduce the risk and reduce the volatility. So it's kind of at odds with that you then see in your accounts that there is a lot of ups and downs, or there can be a lot of ups and downs in the strategy. So in your income statement. So hedge accounting can be applied, which means that if you designate a hedging relationship between the hedged item and the derivative, that all the valuations can go through the OCI instead of going through your P&L. And therefore that reduces the volatility and everything looks much more stable in your financials.
Okay, so it's removing some of the volatility associated with derivatives that would be pushed generally.
Because there can be accounting mismatches caused by the derivatives being in place, but maybe the hedged item isn't being recognised in the same way in your financial statement.
Understood. That was supposed to be an easy question. Very technical answer.
It's a technical subject. Try and keep it simple.
That's so obviously, Marie, this is driven by accounting standards, right? It's hard to believe that it's nearly 20 years, I think, since IAS 39.
IAS 39
sort of originally introduced
came in, and really, I guess it's one of the things that gave people a lot of perception that there's a lot to applying hedge accounting. But thankfully, it was replaced by IFRS 9, which is the accounting standard now in force, and it's a lot more objectives based. So there's less of the sort of rules that were in IAS 39, like that your hedge effectiveness had to be between 80 and 125%, and if it went anywhere without that, you had to de-recognise the hedge. Whereas now in IFRS 9, it's a lot more about looking at your risk strategy and your sort of management strategy for your hedging. And once that kind of all lines up, then you can apply hedge accounting. Then under US GAAP, we have ASC 815, which is, pretty consistent with IFRS 9. As with a lot of US GAAP standards, they're a little bit more rules based, so there's more kind of rules and different modeling that has to be followed, whereas IFRS 9 is a little bit more flexible in terms of looking at the overall risk strategy and economic relationship of the hedge.
Okay, very, very interesting. So there are obviously significant commonalities between US GAAP and IFRS.
Absolutely, and the same kind of modeling and documentation can be used for both.
Okay.
There are some minor differences just in the minutiae of the different hedges, but in general, they're quite broadly similar.
Yeah, fair enough. Yeah, you mentioned modelling and models. What are the sort of common models that are adopted?
So under IAS 39, a lot of people set up models with hypothetical derivatives and dollar offsetting, very kind of more complex stuff. But under IFRS 9 now, there's kind of a lot more options, and you can look at different ways of sort of proving the economic relationship between the hedge and the hedged item in that kind of way. So
So this can get complicated, right? And often that complication acts as kind of a barrier to people maybe doing things that they might have done. But in reality, Marie, whilst there are very complicated elements of this, what are some of the more common treasury activities that might have hedge accounting adopted
So
better, more easily understandable maybe?
yeah. So there's three different types of hedge accounting relationships, and the most commonly used one is called a cash flow hedge. It's quite straightforward to implement, and basically, so an example would be, so if you had a US dollar based company and you were expecting to receive in euros in the future, and you bought a forward based on that, you would have to value that derivative in your accounts in the intervening periods, but you might not have the invoice yet recognized in your accounts. So therefore, you could have like a big income or expense in your P&L that is not matched. So you can set up a cash flow hedge, and that's where you've hedged the future cash flows of the derivative, and it's quite a straightforward thing to set up, because you can easily see what the cash flows are going to be and what your market FX rates are going to be.
Yeah, and then with the exception of cash flow hedges, what are the other sort of?
The other is fair value hedges, which is where you're hedging against movements in the market. So, for example, if you had floating rate debt and you entered into an interest rate swap, to swap it to fixed, that's a clearly defined economic relationship between those two, and you can set up a fair value hedge, and you can move all the related increases and decreases in valuations to your OCI instead of your P&L. The third type then is a net investment hedge, and that's used where you have a subsidiary that's currency is not the same functional currency as your parent. So then any revaluations of that entire subsidiary can go through your OCI.
Yeah. So it strikes me, Marie, just saying what you've outlined there, that FX hedging, generally speaking, is a much more active activity.
FX activity, and also commodity hedging are both quite straightforward, because the valuations of them are quite straightforward. Like you have a future commodity price or a future, your FX rates, you can kind of see. Whereas with interest rate swaps, they tend to be more complex because you have to look at the future interest rates and that kind of thing.
So, but I guess on the plus side, I suppose FX hedging and commodity hedging in the Treasury world are activities that are undertaken on a very regular basis.
Yes, exactly, exactly.
So that is at least an easier adaptation, right? Whereas the more complex, in terms of interest rate swaps and the likes, tends to be, done on a more periodic basis. Yeah, exactly. So it's interesting that it sort of works out well.
Yes, it does. Yeah, and I mean, you can have, the system set up. You can set up the system and the framework and apply it then to all the different FX hedging relationships that you have once you have it set up.
It's interesting that you say that, because we mentioned perceived complications and difficulties.
Like hedge accounting documentation and that kind of thing. So the really important thing is that everything has to be decided in advance. You can't look at a hedging relationship that you already have in your accounts and decide to hedge account for it. It's somewhere in the middle. You really need to decide in advance and set the whole framework up in advance. You need to have hedge documentation in place. And it needs to be maintained, and the hedge documentation will need to set out your full hedging strategy. So it'll need to include items like what the hedged item is, how you're hedging it, why you're hedging it, how it's going to be effective, how you're going to measure it, how often you're going to measure it. But I mean, you can set up documentation that includes all those aspects, and it can kind of be like a form that you fill in each time you're creating a new hedging relationship.
So there's an initial implementation sort of requirement, but then because often the relationships are repetitive,
working, it's
interesting. So this shouldn't be a barrier really to people doing the right thing from a risk management perspective.
Yeah, it's just something that needs to be planned in advance and looked at, before the hedge is entered into, and thought about in advance, and all the different strategies that are already going to be in place. Like you're already probably going to have a strategy, a written risk strategy or hedging strategy, and you can use all that information then in your hedge documentation.
It's interesting you should say that, because we're obviously working in the kind of Treasury world, but we'd often talk to clients who may wish to implement a particular hedging strategy, be it FX or commodity or whatever, but when they then raise it with their accounting team, the accounting team sort of, because they don't really have experience in that area, kind of almost shoot it down immediately.
There is an administrative burden, but it's definitely manageable if the right systems are in place. And if you have a treasury management system which is providing you with all the different valuations, you can definitely use that to test your effectiveness. And definitely there is a perception that fair value accounting is more straightforward, but really it's only some add-ons that
Yeah.
are required to
Yeah,
get to the hedge
similar,
accounting stage.
Yet the impact on the volatility of
Yes.
P&L can be
Yeah,
massive. So
it can be. So
well
it's
worth it.
definitely worth considering
Yeah.
if there's volatility going through the P&L. Yeah.
So, I mean, you kind of touched on the implementation there, and I think what you're saying is that look, it can actually be simplified. And you don't really need to be concerned about it. And once sort of set up, particularly if you have proper systems and the likes, is the ongoing work associated with hedge accounting much greater than that associated with standard?
I mean, there is additional work because you have to keep looking at whether it's effective or not. At each period end, you'll have to consider, is it still effective? Is there still an economic relationship within the hedging relationship? And just check on all that and make sure that all the hedging documentation is being maintained as you go along, and that the testing is done at all the periodic times. But I mean, even if you feel that the hedge has kind of gone outside of the criteria a little bit, there is IFRS 9 allows for rebalancing, so you can adjust your hedging ratio and come back in to meet the criteria again, rather than having to recognise everything at that point.
So it's not a kind of one shot only.
Not with IFRS 9. It was more. It was more difficult with IAS 39, but with IFRS 9, it's a little bit easier. Yeah, because there's such a focus on the economic relationship. Yeah.
So, I think, Marie, what you're saying is that look, this, the fear of hedge accounting shouldn't be a barrier to doing the right thing from a risk
absolutely
management
not.
Perspective, and that it takes a little bit of thought and setup. But then once you have the framework in place, it's actually pretty manageable.
Yeah.
I mean, of the activities that we've talked about there, and I can kind of anticipate your answer to this maybe, but which ones would you see as the ones that provide the most value from a hedge accounting perspective?
Well, like we were talking about the FX hedging, like that definitely, if you're not in a position yet to recognize the items that you're hedging in your accounts, like it's definitely worthwhile, because there can be big valuations on maybe FX forwards or FX swaps that you would have to recognize through your P&L, and could cause you maybe a big loss or whatever in your P&L. And if you can post that through your OCI until such point as you're recognizing the underlying item, then it makes things look a lot better in or a lot more reflective of your actual position in your accounts.
So I think you said it very well there, and that like really what you're doing is trying to ensure that your hedge value, I suppose, is reflected in the same period as the underlying element.
Exactly. Because I mean, the whole point of carrying out the hedging is that you want to reduce the risk, and you want to make your not have those ups and downs in your P&L when you eventually realize that. So why not try and have it more stable while you're
it's ironic that without hedge accounting, by trying to reduce risk, you can increase P&L volatility in the medium term or in the intervening term. So Marie, just as a matter of interest and to kind of wrap up, like what if you were starting with a blank page, sort of, what advice would you give to someone who was going about implementing a new sort of hedge accounting strategy or application?
Yeah, well, firstly, look at, like, as I said, it's not obligatory to apply hedge accounting. So certainly look at whether it's worth doing and whether, it will benefit you to be able to reduce those ups and downs in your P&L. Or, maybe it wouldn't have enough of an effect on your P&L to go through the different documentation, the modelling requirements that are involved. So that's the first thing. Then if you do decide to go ahead with it, look at setting up a system where the hedge documentation is going to be set up in advance. Try and reduce the work involved in setting that up by having a structure involved where you just put in the new details of the new hedge each time, and then look at how you're going to see how effective it is, and how your journal entries are going to come out of your valuations that you can usually get out of your treasury management system.
So a measured and kind of planned approach will take away any
and once
fears.
It's up and running, then all your and your hedge documentation is maintained, your auditors will be happy, and all your valuations and journal entries should all follow through.
Brilliant. Well, Marie, thanks for that. Very interesting. I know it was pretty high level, and it does get very technical and can get very complicated as we know. But really, I suppose what we were trying to show is that this is nothing to be afraid of, right? And there are simple ways to go about getting sort of the 80-20 rule in terms of benefits. So thank you very much. Very interesting. Folks, thanks for listening in to today's FTI Treasury Talk. I hope you found it interesting. If you want any more information on hedge accounting or treasury outsourcing in general, please hop over to our website, www.ftitreasury.com. There's loads of resources there, and you'll also find contacts for myself and Marie and lots of other members of the team. We're always looking forward to talking to people in terms of any kind of treasury requirements they might have, or even just from an information perspective, touching base with the treasury world. So thanks.